Good afternoon, everyone. Welcome back to the Market Insights webinar, where we work each week to provide you some insights to the overall market, plus answer some questions that you've been asking this week throughout the survey that we sent out. We're going to spend the next 30 minutes giving you some insights to the overall market. Specifically, with this week, we're going to focus in on gold, and then again, one more time, answer your questions. I have joining with me today Patrick Cernezda from the TMX as the educator, as well as Mark Raves, head of product from BMO ETFs. And what I'll quickly note is that you will get at the end of this a survey of the actual session. In addition, you will get a chance to ask us some questions so we can use them for next week's session. With that, let's get into it this week. First, I should highlight right off the bat a little bit of disclaimer. You should not expect this to be advice. This is just general insights to the overall market itself. So with the focus in on gold, you're certainly seeing in the news more and more these days. And that's why we thought we'd spend some time on it today, because we had a lot of questions come in, specifically in around gold. And we're going to answer some of those questions a little later on. But first of all, I'll give you some backdrop. And in case you haven't been aware of it, you're certainly seeing the governments out there start to double their balance sheets and certainly really increasing their debt out there. And people are looking at gold as maybe that one way of storing value out there. Now, of course, that's not the only thing to look at when you think about gold. There are other factors to consider. For example, the strong USD backdrop. Also, the fall in equity markets bring volatility into space. And then, of course, there are some conversations out there about the natural demand from gold, maybe a little bit weaker going forward with India and China. So, a few things to factor when you look at this area of the marketplace. But interesting to see right now, gold has been one of the top performing assets on a year-to-date basis. Thank you to the Bank of America for their research here. And then further, it should highlight that when we say that, it's not been a straight line up. Gold itself has been part of the volatility, and we're certainly seeing a chart here that's showing you that there has been volatility in that market, as there has been volatility in other markets like the equity market, as shown here through SPY. And the last thing, of course, we're seeing from gold out there is we're certainly seeing gold hitting some highs that hasn't hit in some time, certainly drawing people's time and attention towards this space. And that's why we're going to spend a little bit of time diving in it today. Before I do, maybe Patrick, you can spend a little bit of time here. You're going to talk about a little bit some of the things you're seeing in the gold space.
Right. Well, it's interesting because gold's been doing very well for the last year or two. I mean, we went through a bear market that essentially lasted from 2011 all the way through 2015 was where we really started to see the actual bottoms. But the real gold breakouts didn't start till about 2018. And so we saw a very nice uptrend. But during the actual market crash that happened here in March, what we saw was a period where is that old adage that during a market crash, the correlation of all assets becomes one, because what's scarce during the environment is cash, and when someone is being margin called or forced to liquidate, they tend to not discriminate between assets when you're trying to raise cash. And so there was definitely selling pressure that occurred both in gold and gold miners. But what's really interesting is that the Fed and actually all central banks in the world came in with the save, and they basically went and provided historical quantities of liquidity to the marketplace, expanding their balance sheets. And in doing so, it's dilutive to fiat currencies. And so gold suddenly became fashionable again as a safe haven and fully recovered and is doing incredibly well in this environment, right?
Well, yeah, thank you for that insight. That's good. You're certainly seeing it doing stronger in this marketplace. One thing you did for us in the past, and I know you've done it for a chart, is really kind of give us a look at the probabilities going forward. And the chart you provided here is on gold equity, so not specifically gold, physical gold, but on the gold equity markets. Maybe you could talk about the probabilities that you had in the past.
Right. And so when we look at what's interesting, again, you can see that dip back in March at where we saw the gold miners sell with the whole market, but how quickly they not only recovered but broke to fresh 52-week highs. And that's actually a characteristic often that we can associate with very bullish things, where they can brush off a sell-off and then re-resume to fresh highs is a common characteristic. And so when we're looking at the gold miners here in general, you can see that what I'm particularly focused on is the probability on the downside, which is throughout September, October, November of last year, or even into January, more or less this XGD consolidating this $15, $16 range where the majority of the price action was contained. What's interesting is from this rally right now for the rest of the year going out to December 2020, the options market is only pricing in a very modest 11% probability that we could go back and close down back in that trade range. And so at the same time, you can see looking at the $24 strike above, they still are assigning very healthy probabilities of this rally continuing. And again, that's just what the market's pricing in. It doesn't guarantee anything, but it's really interesting to see just how everyone is positioning in the gold market. Oh.
Yep. Hello?
Oh, there we go. Hey, Kev.
As long as we still got you there.
All right.
Hope everybody got that piece. But yes, I see what
did
you're talking
I
about, the
cut out?
probabilities there.
Okay. Oh, sorry. Yeah, no, I cut out at the probability. I was just saying that the probabilities here is just, it's suggesting here that the markets are going to have a very good support from all of the base that it had throughout 2019 and 20, and there's a very good chance that this rally can still continue. At least the market is pricing it that way, right?
Yeah, I mean, that's good insight to the overall marketplace itself, especially, we're seeing the gold itself, and this is the gold miners on top of it. Hey,
Right.
Mark, just to bring you into the conversation here on this, there certainly is a number of different ways of access, and we talked about physical gold and saw the movement of physical gold in the marketplace. And, Patrick's talking about equities and the probabilities around the equities. Maybe we can start off the conversation, talk about maybe the many ways you can access gold in the marketplace, and of course use the backdrop of an ETF. I know you prepared a slide, so I'm going to put that up to help you kind of navigate through that. I know there's a few ways, so maybe we're going to spend a little bit of time on this slide. Let me hand that to you, Mark.
Sure, thanks, Kevin, and appreciate everyone joining us again today. I think the real key difference when you look at gold or any commodity-based exposure is to realize, are you going to use equity-based or are you going to use commodities, whether that's physical or using futures? So of course, with the commodity, you're getting the pure exposure to the commodity. But as we've talked about before, with oil and a couple of other things, there are certain risks to doing so. Equity-based, of course, now you're getting the companies that essentially are the gold miners. And so, yes, they move with the price of gold, but as well, there's equity risk attached to them. So when we look back to March, there was a bit of a dislocation between the price of the equities, the gold miners versus gold, where the equities were being influenced by the broader sell-off. And as Patrick mentioned, when correlation started really rising, they were caught in that. So two key things to really think about. Again, with the equity-based, you're aware of the fact that you've got equity risk on top of the commodity risk. And on the commodity side, certainly you're getting a pure exposure to the commodity, but depending on how you're accessing that, there could be other costs or features of rolling contracts if you're dealing with futures. So different things to keep in mind as you look at it. Thanks.
And maybe dive into a bit more. I mean, you also have in the equity side, junior versus seniors and that kind of aspect. Any insights you can provide there?
Sure. With a senior equity, you're getting the larger, more mature companies that actually have operations. So for BMO, that's the ZGD equal weight gold miners, which is generally the larger cap names. As an offset to that, you could go into a junior or a more small cap. So in BMO's case, offering ZJG, the junior gold miners. The difference there, of course, is you're getting much more into the smaller exploratory firms. So they tend to have greater leverage in their price to gold, just like how small caps have greater leverage overall. So they're much more opportunistic as an investment, maybe a little more tactical as a play, where when the price of gold goes up, the juniors are going to respond a lot more. But when the price goes down, the same effect is in play. So a more defensive play is certainly the senior, like ZGD, and a more opportunistic play is the junior, like ZJG. Thanks.
So Mark, I mean, staying with the equities concept for a bit more, give us some insights on kind of the price performance of, gold, equities itself, and then maybe talk to us about the flows you've seen kind of the gold and gold equities themselves in the ETF space. And I know you produced a chart for that too. Bear with me. There we go.
Sure, thanks, Kevin. And as we look at this, I was alluding to it on the previous conversation, you do see a disconnect through March, where the blue line is the equity-based ETFs, the GD, and then the red line is the commodity itself, gold. So while gold did come down through the month of March, the equities actually came down significantly further as they suffered with broader equity market risk. But then once equity started to recover, and as well gold recovered, you see almost the double effect on the equities. And since the lows of a month ago, ZGD is up over 60%. Some may turn around and say, is that a done trade then? Well, if gold, there's a lot of reports out there that 1,700 is the tip of the iceberg. I've seen as high as 3,000 from analyst reports. If gold continues to advance, these equities, of course, would advance alongside it. So an interesting dislocation during the month of March, but that's already corrected through. So now it's far more, what's the direction of gold itself going to be over the upcoming months? In terms of flows, having just come through month end, we did certainly see an increased amount of flows into gold equities and gold securities-based ETFs. They both popped up into the top flow charts, where they're not normally some of the top flowing ETFs. So certainly there's heightened investor interest with all this stimulus coming to market that was talked about at the beginning of the call. Certainly gold trade as an inflation hedge, as portfolio diversifier makes a lot of sense. And if the price is going to roll, just an opportunity to capture that trade going forward. Thanks.
Thanks, Mark. And go to you, Patrick. I know we talked a bit about a few ways of ETFs to play in the marketplace, but let's talk a little bit about options, your background there, different ways of accessing or playing the marketplace through that, and maybe a couple examples too, if you can.
Right. Now, what's actually really exciting about gold and gold miners and particularly options on them is that Canada has a very wide selection of gold miners and liquid options chains on them. And so it's a very accessible market, particularly when you're focusing on the mid to large cap gold names. I just named here a handful of them, but there are actually at least another 5 to 10 further ones that didn't make this list that are also gold miners that have options on them. And so really you have a lot of different choices of where to go and how to build strategies around them. So you have everything from ETFs as well as the individual gold stocks themselves. And every major gold miner in Canada pretty much has options now listed on them. So if we go to the next slide, what I wanted to do was actually show a really fun example, because one of the really neat things, and you showed it on a chart earlier talking about the volatility in gold itself, but one of the things that we have witnessed over the last 2-3 months was a massive expansion of implied volatilities, not on the only on the whole stock market, but it also has influenced many of the gold miners as well. And so there's very rich premiums on out of the money strikes in order to enhance income. And so I really felt it was a worthwhile exercise to go through an example of how an investor can do this. So just in the most basic form, covered calls are probably the most popular strategy. And in fact, like Mark, I think over the last many weeks has shown, there's a number of even covered call writing ETFs that actually systematically do this for you. But what I want to illustrate is this idea of a covered call on an individual gold mining stock. And so for a retail investor to be able to do that, it's pretty straightforward. It can even be done in registered accounts. So you can do this in an RRSP or a TFSA, and it involves owning the physical shares. And the really cool part about this is that there isn't anything associated with it that you had to buy the shares the same time as you did covered calls. So you may have, let's say, owned Barrick Gold in your investment portfolio for the last 3 years, and you can just choose tomorrow, well, not tomorrow, Saturday, but let's say on Monday, to turn around and sell a covered call on Barrick's on Monday. There's nothing associated. You just have to physically own the shares for the call to be covered. And what we're doing is we're selling a call premium. So going back to how an option is structured, the buyer has a right to buy, and therefore the seller of the call has undertaken an obligation to have to potentially sell it to them at a specific price over a specific period of time. Beyond all the jargon, we'll actually look at a real example of this. So let's move on to the next slide. And so again, the key criteria, the investor actually has to physically own this stock. So you have to have the shares in your investment or trading account. And we're using the option as an income enhancement, a way to generate a return that is not dependent on stock appreciation. It's therefore has a lot more characteristics to something like a dividend, because you don't need a stock to rise to receive the dividend. You also don't need the stock to rise in order to harvest a call premium. And so this is it's a diversifier in terms of the ways you create your returns. So you're not dependent on actually market timing or needing appreciation in your stocks to actually make those returns. So if we go to the next slide and take a look, what we have here is we're using an example on Barrick Gold. And so assuming our investor in this example owns 100 shares of Barrick, it was trading at $38 when I was doing this example, but you could have owned it from $25 and you could have owned it for the last 2 years. And even though it's trading at 38, you can sell this covered call right now. And so, but our investor in this example wants to do an income enhancement for the next 5 months. And so they go out to October of 2020, so today's May, and they're middle of May, so it's going to the middle of October expiry. And they turn around and they want to sell a covered call at $46 a share. So the stock's at 38. So our investor actually continues to participate on the upside of Barrick, but they have entered a contractual obligation that if Barrick went all the way up to $46, that they would have to sell their Barrick Gold shares at $46 a share. So you've capped your upside. You've traded the potential to make more than $46 for a guaranteed $1.70 income today. And so that $1.70 or $170 per contract equates to being a 4.5% income an income enhancement that you've earned for undertaking this obligation. The really cool part about this, like a dividend, that $170 is credited to your account immediately. And so you will literally see the cash balance. The moment you sell it, you will see your cash balance increase by that $170. But you still have an obligation all the way until October. And so it's a way that a lot of investors and traders and even investment advisors use as income enhancement strategies, and as ETFs, such as the BMO ETFs will do, is they'll write this premium as an income enhancement within there. And what's really cool about gold is it's just such a large volatility premiums that you can go like $8 or 20% higher in Barrick and still get what many would equate to a dividend style income, and that's 4.5% in just 5 months. That's not even an annualized number, right?
Interesting opportunities. I like the way you kind of introduce an income way to play gold too, for that matter.
Yeah.
Let me move into a little bit of the questions we've got from our audience. The first question, of course, really relates towards gold. And Mark, I'm going to start with you on this one. really what the investors are looking at, will gold take that hit again? It certainly, had a challenging time in March. Will it take that hit again? I know you did a chart for us here too, so I'll bring that up to help you answer it.
Yeah, I think there's two things to think about. One, what really caused gold to come down in March, and people point to two things. One is margin calls, as mentioned in the question, and the other is really just a collapse of demand. And when you think about demand, kind of half of it comes through investment, and half of it actually comes through physical use in jewelry, particularly out of Asia and certain areas of the world. So that demand has already clearly flattened. It'll start coming back slowly, but I don't think we have that same risk of a sell-off there. So it's really more on the margin side of things. And do we think there's a possibility that we get an equity correction? Certainly volatility is still high, so that risk is definitely out there. And if that was to occur, I do think we would see some move down alongside it. But what would that mean is potentially further stimulus, from the BOC, from the Fed, et cetera, to offset that, which of course would be accretive to gold. So I could see a short-term dislocation, certainly because volatility is very much heightened out there across asset classes. That risk is still very, very clear and present, but hopefully not to the degree that we saw in March. Thanks.
Hey, Patrick, just on the same slide, one thing we talked in the past is, basically buying insurance. What would somebody do in this case situation? Let's say they have a position in gold right now. They want gold equities, that is. They want to put some insurance in there to maybe mitigate that volatility of potential for them.
Right, and so you definitely can, like we talked about in past sessions, you could buy protective puts and actually hedge downside risk. But one of the strategies that I'm a very big fan of in the gold markets, I'm going to use a more complicated term. The volatility skews that are associated with gold actually have a really nice U shape. Normally, you don't get a lot of volatility premium on the call side, but in the gold market, it's a really nice balance. And so one of the great strategies that you can do is buy a protective put, and like we illustrated with the covered call, you can often sell call premium above to help finance the cost of that put. And so there are lots of really interesting strategies in the gold markets where for almost a very little to no cost, or it's often just a small debit, you can put some really interesting hedges on your gold miners, continuing to have upside and yet still having some insurance to protect you if we had one of those kind of liquidity style events occur later in the year.
Yeah, thanks for that insight. Mark, I got another question for you coming in, and this is in regards towards specifically sectors. So investors are looking for insights on how sectors have behaved in respective markets, really to help them decide how to tilt their portfolio across the board. I know you've done some research in this area. Maybe you can share some of that, and I'll put that up on the slide to start off with.
Sure. I think it starts with an investor's view of where we are in terms of economics and markets, and whether you think we're going to be coming back strong, or if you're more of the consensus that it's going to be a slow recovery dominated by physical distancing and potentially more COVID-19 cases since we don't have a vaccine. So I think definitely some defensive growth is in order. And so if we look at a chart of where sectors fit in, I don't think it's quite time for those cyclicals. So I don't think you're talking about energy names and things of that nature. You want to be a little more defensive in nature. And as well, from a factor perspective, if you're looking that way, I think defensive makes sense too. Things like low volatility or quality tilts within the portfolio. So right now, we're certainly seeing more flows into defensive sectors, whether those are the consumer sectors, and of course technology and healthcare, because of everything that's going on in the world right now. Far less so into energy, into banking, things that are much more cyclical in nature. Thanks.
And here's just a backdrop of the different sectors and the performance of those. I know your team put some time to put this together there, Mark. Maybe you want to quickly talk about this too.
Sure. I think this chart kind of speaks for itself, but a lot of different things that can be going on in the marketplace. But generally, by looking across the cycle, you do really see opportunities in certain sectors. I think when you get into the cyclicals, I mentioned, when energy is really going, it can jump to the top of the charts. Right now, people are thinking far more about information technology, about healthcare, just because of the COVID-19 impacts and the fact that, healthcare and IT are going to, of course, be big focuses going forward. But using sector ETFs as satellites in your portfolio, or maybe around a disciplined broad beta exposure as your core, is something that can really add value to the portfolio, which this chart clearly demonstrates.
Thanks for that, Mark. So we also have a question here in regards towards iShares Global Clean Energy. It's an ETF in the States, and they're looking for one that is available here in Canada. And the ESG part of the business is still evolving here in Canada, so there'll be more exposures that come along as you see. But ultimately, if you want a snapshot what BMO offers in the marketplace, I'll just quickly put the tickers up for you. We do cover the broader markets in the global area, both Canada, international, US, but also then too some fixed income, and further and foremost, a balanced solution if you're looking for a place to start, plus a cover call solution, very similar to what Patrick talked about before, but this is now on global equities itself. Now, to answer the question, if you're looking for solution sets in regards towards ESG and trying to find specific products in ESG, a great little resource for everybody out there is right across the bottom of the page. There is a hypertext link. I'm not sure if it's going to work on your side. Maybe you want to make a note of that. But the RIA, that's Responsible Investment Association of Canada, on their own website has a tool that helps people identify different companies out there with different exposures in that ESG space. So take a look at the resources they offer. Can really help you get at the exposures you're looking at in the marketplace. Mark, let me go back to you for now. With me. We had a question last week about generating income, and specifically in around cover calls, selling puts and buying calls. Can you give me some examples of different kind of ETFs in space that do this kind of activity?
Sure. There are covered calls, which we've talked about in the last few calls, but as well, if you want a more dynamic option strategy, products that are known as premium yield tend to have both calls and puts in them. BMO just recently brought out a premium yield product, ZPAY, earlier this year, which does exactly that. So it's got some equity exposure, typically up to half the portfolio, and then we're writing calls on half of that, so again, a quarter. And then with the rest, it's backed by T-bills and invested in put options. So that's a strategy that makes a lot of sense for today's market. If you're sort of unsure on the direction of where markets are going, you do get a higher yield with lower equity market risk. And what I really like about it is it's quite dynamic. As markets sell off, you'll see more weight go into equities and call options. As markets get more rich, you'll see more weight go into cash and the put options. So a dynamic strategy that really looks to harvest yield off the volatility in the marketplace. And unlike a covered call, it doesn't have full equity market risk.
And then stay with you for a second there, Mark, too. We had a question around our cover calls, and we were talking about a bit on that session around return of capital. And really the key here is people just want to have insights of where to find information on an ETF's return of capital, potential return of capital, to help them make a more informed decision. So maybe you can highlight where you find that with inside our own website to give them that insight.
Sure, all the ETF providers will make that information public on their website. So typically when you go and click through to the product pages for an individual website, there'll be a tax attachment. In our case, there's actually a distribution tab. You can go in there, you can flip it to prior year, or there'll be a PDF report of the prior year, and you can see exactly how that ETF allocated out its distributions from the prior year. I would certainly caution that that doesn't exactly mean it's going to be the same year over year, but it's going to give you a strong feel of how that ETF distributes. Keeping in mind with covered calls that the return of capital, the good return of capital mixes with capital gains, so it also depends a bit on the direction of the marketplace. But regardless, looking at these distribution tables or PDFs is a great way to get a sense of how that ETF allocates its income distributions. Thanks.
Thanks for that, Mark. And good to point out there is good return of capital and bad return of capital. And you got to factor in the fact that we're earning the yield behind the scenes. You know, I'm going to go right back to Patrick. Patrick, I know you do a lot for education around the TMX. Can you give us some insights on how you can support people in their quest to find out more information in regards towards derivatives and options out in the marketplace?
Well, for sure. And, we talked about strategies such as covered call writing or buying protective puts. And then I even mentioned the term collar, which is a combination of the two. There's amazing resources on the Montreal Exchange website for education, and they're all completely free. And so there's strategy guides and explanation of every strategy on there, separate PDFs on all of this, just an amazing resource to go in there and just learn about all of the amazing things you could do with options. And you can also register if you go to the next next page there. You can also sign up for Options Play, which is a great resource where you can screen the Canadian market for all these different strategies, and it's completely free.
Hey, Patrick, you also, in our conversations, I take a little bit deeper in with you. I understand you have your own podcast too you run on a regular basis. Maybe you can give a little shout out for that too, please.
Oh, well, thanks a lot, Kevin. Yeah, no, I'm part of actually two podcasts. One is Macro Voices. We do a big macro interviews with all sorts of people like David Rosenbergs of the world. And then we have a Market Huddle podcast where we have a lot of fun and we drink some beers on a Friday and actually talk about the markets and all the really cool stuff. So make sure you check them out.
I hope you didn't start too early yet.
At 4 o'clock. We have to wait till the market closes.
All right, everyone. Thank you again once for joining us this week. We'll be back next week at 1 o'clock again. You'll get a survey of the actual webinar today. Look forward to getting your questions so we can spend the time and effort and working to answer them for next week. Thanks again for joining us. Have yourself a good week ahead. Cheers.